Last Friday, we saw the S&P close up fairly strong, nearly green right across the board, and that also relates to the industry we're focusing on today, the drug manufacturing, with Pfizer itself up more than 2%. So that was a nice way to close for shareholders, but today we want to understand, is there a massive opportunity to buy this company right now? Bear in mind, it is yielding around 6.55%, so can we get those very large dividends as well as potential future growth, or do we also need to consider the potential of a looming dividend cut? Now, we're going to uncover all of that information today, as well as give you our valuation and where we see this company over the next few years. But it is important to understand where they are right now, and no better place to look than their more recent earnings, which, as we can see, they top their earnings estimate as well as increasing their full year guidance, and they do put some of this down to the COVID products, which did help that top line grow. Now, when we dissect the actual information in terms of the numericals, well, look at that. That is phenomenal on the EPS, 106, nearly double what was anticipated by the market at 62 cents. And the revenue equally as strong, 17.7 billion, above the 14.95 that the market were anticipating. As we saw, it wasn't just the essential revenue that they had increased, but also the earnings per share they now anticipate for the full year, 275 to 295, and the previous guidance 245 to 265 is welcoming noise to shareholders. We also get to see here that revenue's been increased 61 to 64 billion, and we can see that is an increase between the previous guidance of 59.5 to 62.5. Now, there are some other bits of information that we will cover about their earnings in today's episode, but we also want to highlight the massive swing that we saw for this quarter. For their bottom line, they reported 4.47 billion. The same quarter last year, it was in fact a net loss of 2.38 billion. So we are already starting to see some positive signs for this company. They are moving in the right direction, and we should also have some consideration for this activist pressure as well. Now, for those that don't know, Starboard effectively announced they have a 1 billion stake in the company. For those that want to see the relation to the total market cap, well, currently for Pfizer, 145 billion is their total, so not massive in relation to that, but still very significant in the grand scheme of things. And what they had potentially done, remember this was from the beginning of October, was that they were looking to bring back the old Pfizer CEO as well as the ex-finance chief, although it was noted at the time that it was unclear in what capacity. And that was very interesting, as just a few weeks later, when they did report their earnings, the current CEO in place did say that he would welcome some good ideas from the company. Whether or not there was discussions of him being replaced, that isn't something that we are privy to, but we do notice that the active investor on board is looking to turn things around, which ultimately is what the CEO should be doing. They should be putting this company on the right path, and you could argue, given their strong earnings, maybe this is a step in the right direction. And we can see here the CEO himself said he agrees that the total shareholder right now is very poor. Now, he is questioning why that is, and he's already answered it, pretty much a rhetorical question, because we had a significant drop last year. Now, he says, I think we are doing a lot of changes, but if Starboard and anybody else for that matter have good ideas, then he will certainly discuss them and entertain. Now, whether or not that is something you want to hear from a CEO, they should be the one in turn to move the company in the right direction. That can bring up some question marks about the overall leadership and the skills of the current CEO in place. Now, we want to take a look at an article released around the same time from Pfizer, and they believe even with the increase, what we have seen on both the earnings per share as well as the revenue guidance, that it won't heal the deeper wounds that this company currently had. But what's really interesting is where they pinpoint the increase of this guidance has come from, and they say the bulk of this extra gain is COVID related and will not be repeated every quarter. Therefore, whilst at a first glance you may believe the increases are very positive, moving in the right direction, he sees this as a one-off, something that potentially isn't going to recur, and we shouldn't factor this in when considering this company and the good performance we've seen just in the more recent quarter. And he says once you do strip out these gains, the issues that Pfizer have remain unchanged. They are still here. The bearish indicators and they haven't really left. They also question the acquisition, which we will go on to discuss shortly as well, and they believe they have been binging on overpriced deals, and this includes Seagen, as we can see, the loss-making cancer biotech, which they did buy for around 43 billion, and that includes debt. So lots of issues throughout this company that you do need to understand before either adding to your portfolio or in fact adding more shares. And we'll go on to talk about some of the metrics in details, but we can see here Pfizer's return on capital has also fallen from more than 19% in 2022 to 2% last year. So there are question marks over this company, no surprises given the share price drop that we will go on to highlight, and we can note the company is worth less now than before the pandemic after shedding 180 billion in market value over the past 3 years. Now there's a significant amount, as we already alluded to earlier. The current market cap is 145, so they've lost more than half of their market cap at the ultimate peak. The article also goes on to talk about how the activist investor doesn't offer much in the way of solutions. There is no quick way to speed up innovation. Drugs take a significantly long time to develop, again something we will consider when we look at their pipeline, and it is a costly process and requires a healthy dollop of luck as well as investments. Now in terms of a conclusion from this article, they talk about one line of defense might be that it's a cheap valued and therefore a strong contender. It ultimately trades around 11 times forward earnings and therefore a discount to most of its peers, again something we will highlight. And with a very high yield at around 6%, even higher at the moment, if you are someone who believes that all of the news is fully priced in, then now would be a good time to hang on to the stock or consider adding. We then had the news that Trump picked RFK to be his Department of Health and Human Services Secretary, and what was very interesting, we got it from this article, but it was noted that Trump had previously said he would let Kennedy, in quotation marks, go wild on healthcare. Now, no surprises when this pick did come through that a lot of vaccine maker stocks, including Pfizer, did drop significantly. That is also relating to Moderna, Novavax, BioNTech, and GSK. So maybe this isn't something we should be surprised about, but the question is, do we see right now a market overreaction? And if you're someone who does like Jim Cramer, likes what he says, then you will have some faith in the fact that he believes ultimately it won't tank the junk food and drug industry's market. But again, remember, lots of investors have made significant amount of money purely betting the opposite of what Jim Cramer says. Now, the final piece of information before we look at the numbers and the metrics is that we have here something we just mentioned about Donald Trump getting revenge on Pfizer with RFK and his role. Now, we have gone through a lot of information that is shared here, but there are some key points that we do want to highlight, maybe something you didn't hear before, but we can see RFK has said there is no vaccine that is safe and effective, and ultimately the market believes he's an anti-vaxxer, and therefore a lot of these companies will continue to fall during Donald Trump's term. And we can also see Donald Trump has had issues with Pfizer for quite some time. We can see here that he said they did not give him the vaccine win prior to the election, and in his own words, as I have long said, Pfizer and the others would only announce a vaccine after the election because they didn't have the courage to do it before. Likewise, the US FDA should have announced it earlier, not for political purposes, but for saving lives. So a lot of tension. No one knows right now where the market will go, but ultimately we need to understand whether or not this will have any effect in the longer term for Pfizer as a business, and try to wind out any of the political noise which we don't believe will in the long term have an effect for this company. So let's go back to Pfizer itself. As we said, in terms of the yield, it does look very attractive at 6.55%. We get a double buy rating from Seeking Alpha and Wall Street. Now, Quant do give it a hold at 3.44, but also remember, for Quant to flip this to a buy, it would be 3.5, so you could argue they're not far off. In terms of the range, right now trading towards its 52-week lows and a forward P that now sits at 8.76, which is significantly lower than the S&P at around 25, but also significantly lower than the healthcare, and we will show you that as well. Performance over the last year, down around 15%. Over the last 10 years, negative 18%. So if you had invested around $10,000 10 years ago today, your investment would be worth less as of today's date, and that doesn't even factor inflation. If you'd reinvested your dividends, you would be up, but still not only would it be a terrible return on your investment anyway, you would have massively underperformed the S&P. And as we can see, the peak for this company was around December 21, so literally 3 years ago at $60. Right now, it trades less than half of that value. So let's get into it. Is this a great opportunity? First thing that we want to point out is in terms of their earnings moving forwards, they only see growth in the next quarter. The subsequent 3, they are anticipating a decrease. But one thing we do like here is that management historical forecasting accuracy, we give them 100% because they have outperformed over the last 4 quarters. But one thing that's very important to understand, over the next full year, they are expecting very minimal movement, in fact a small decrease to the EPS, and that will in turn, although on a very small scale, increase the forward PE to 8.85. We also want to run through the metrics, also cover a potential dividend cut, but first things first, dividend safety score of 75 is good to see. That indicates safety. We have a double severe undervaluation on these models, which we will run through. 2 things to note. Firstly, we want 4% at the bare minimum in terms of dividend growth. That is just to keep up in line with the inflation rate. Second thing, because they increase it every December, we aren't far away, just a few weeks, to seeing how much they increase it by in 2024. Now, dividend safety score, this was just reaffirmed a couple of weeks ago, so that is very good to see. And ultimately, dividend safe, meaning a dividend cut, is unlikely. So that does give us some faith, but we also need to look at the metrics below. First thing to note though, in terms of the key metrics from the 07-09 recession, they cut the dividend. Now they didn't maintain it, they didn't increase it, something to consider. And in terms of recession sales, -6%, that is above the S&P, which was -12. They also outperformed the S&P, -45, the S&P itself, -55. Dividend growth, nice to at least know over both the last 5 and the last 20 years, they have been increasing those dividends around the inflationary rate, and they've also been increasing the dividend for the last 13. Now the first valuation model we are looking at is the P ratio, and when we zoom in to over the last 12 months, the blue tunnel representing the expected fair price, right now for the first time in fact over the last year, this is sitting outside of the blue tunnel, and that indicates severe undervaluation. Now 2 things, firstly we're not looking at any one of these models in isolation, and the second thing is we're going to conclude when we run it through our own valuation process towards the end. Now dividend yield theory tells us a company is undervalued when the current yield sits above the 5-year average. That is one massive undervaluation signal, 6.55, that is the highest yield that it has been over the last 5 years, and then the other undervaluation, 10.2 on the forward PE, below the 5-year rolling of 11.7, but also lower than healthcare overall at 15.7. So we do notice Pfizer is trading at a discount to the overall market, and we will compare the metrics against the sector to understand if it deserves that discount at all. Now in terms of free cash flow, we want to see 60% or lower, and this is a side note that we do ignore the earnings on this channel as it is susceptible to manipulation by management through accounting, and we use this figure here so that essentially it gives us faith management can offer strong dividend increases. No surprise, 2023 was very poor because we got a triple digit on the free cash flow, something you wouldn't be able to dissect from the earnings, and in turn this tells us that management paid out more in dividends in 2023 than they generated in free cash flow. Positive to take, over the next 12 months this is anticipated to come down to 66%. We then move on to the free cash flow where we want consistent increases over the longer term. Not something we get, no surprises either that it had have a very large increase during the COVID era. Since then it has come down dramatically, something that we did take note of earlier in the episode, and we'll see this reflected right across a lot of their metrics today. Very good performances, in fact, from 2020 to 2022, and then before that, very stable, after that a big drop. The other thing we can take away, over the next 12 months, it is expected to increase rapidly to around $2.53 per share. Again, no surprises reflected in the sales growth, pretty much very, very poor revenue from 2014 to 2020. Then we get the COVID bump of 21-22, and then that massive drop in 2023. Now we also noticed, based on the trailing 12 month, that the top line revenue is anticipated to be down again in 2024, but at a smaller rate than the previous year. And from a numerical perspective, you can see the increases and the decreases over the last 10. Now, shares outstanding, we draw your attention to this. We want to find out, do companies return excess cash to shareholder pockets? The answer for Pfizer is yes, but at the same time, it is very, very inconsistent. And you can see they have also issued shares and diluted your position during some years, for example, 2020 to 2022. Again, something just to bear in mind. Now, ROIC, one of our favorite metrics, we personally want 10% or more. Give us faith, management are able to effectively allocate their capital. Very good from 2014 to 2022, Drop into 2023. Takeaway here though is it is increasing, in fact 7% on a trailing 12 months, so hopefully this does look like it is starting to turn around, and we do start to see that across some other metrics like the operating margin above 12%. We get that nearly every single year, but we also notice inconsistencies. Yes, it's dropped into 2023, but nice to see, like we saw in the ROIC, a bump up on the trailing 12 month, 19%. Now remember, not just for Pfizer, but other companies as well, when we do dissect the operating margin, we want increases to the revenue, but we also want to see increases in terms of the operating margin to give us that operating efficiency, and those are the companies we deem as high quality. Free cash flow margin looking very strong. We do get the drop into 2023, a nice jump on the trailing 12 month, and nonetheless above the minimum 5%. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, and this one we use this metric because it correlates to dividend safety, balance sheet strength, and does give us some signs of if a dividend cut is looming. Now below 3 is what we want to see. That is what we get nearly every single year, and the numbers that you see below reflect the number of years it would take the company to pay off all of their debt net of cash on hand. 3.75, very high in 2023. We're going to cover why. One of the reasons was their Seagen acquisition, but we do notice on the trailing 12 month it is down. Over the next 12 months, expected to continue down. So these are positive signs. As we will show you now in the investor presentation, they are looking to delever the balance sheet and essentially pay off a lot of debt, which in our eyes is the right direction, as it has been very, very high from that 2023 figure of 3.75. So just a few things to take away from their investor presentation in case you missed the previous episode. We notice their revenues are going up, their sales are going down, and their earnings per share are going up. These are all metrics we want to see move in these directions, so we do take that in terms of their latest earnings as a positive. And then we move on to how they are allocating their capital. Remember, we cover this on every company if it is included, because we believe it is incredibly important to understand how management are using that capital. First thing is in terms of returning to shareholders directly through growing their dividend, paying out a very large yield, as we said, around 6.6%. Paying down debt, great sign. This is something we love, and no surprises for a company in this industry. They are investing heavily, 7.8 billion. You will notice that is the largest out of the three in terms of their allocation into R&D, which is essentially research and development. Now, share repurchases, as we did highlight earlier, they don't have anything planned in 2024, so don't expect that. And their overall message into terms of what they want to do moving forwards is post their acquisition, they want to deliver the balance sheet, and they're saying expect more balanced capital allocation, similar to what we see above, between reinvestment as well as returning value to shareholders, something we continue to talk about on this channel. And for those that just want a reminder as to how those increases were into the guidance, revenue up as well as their earnings per share. But remember, when we did take a look at that Financial Times article, they were saying a lot of that bump is essentially due to COVID, not something they believe will continue into the future. Now, we also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks that we believe deserve your attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can start reading straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next 12 months. And on top of that, you can grab another recently released spreadsheet that talks about 29 undervalued dividend stocks with the most upside that Wall Street themselves see over the next year. So click below, sign up, and you can start reading straight away. One thing that we find very interesting to do, and you may want to do it in companies that you're invested in, like Big Pharma, is just take a very quick look at the pipeline, how many candidates they have, how far along they are. And this is something that you can easily do by just typing in the company and then typing in the word pipeline, and it should bring up something similar to this that we can see for Pfizer. And this is as the end of last month. These are the phases, and the further along they are, the nearer they are to being released. Right now for Pfizer, we can see 46 in the initial phase, around 30 in phase 3, and 4 in the registration. Now, this isn't my particular field, so I won't get into any detail of what these relate to, but just something we do find interesting that you can take a look at if maybe you do know a little bit more. For example, when we look at registration, we can see 4, and again, you can just go through these. We do believe some viewers may find this information useful. Then we just want to highlight, we have talked about it, so maybe we could have covered this earlier, but this is the acquisition for those that didn't know in terms of Seagen, and as we can see, this was released around December 14th, so we are talking about a year ago, something ideally we would like to see show up in the numbers in terms of the growth. Pfizer essentially completed the acquisition for around 43 billion. We'll take a look at their balance sheet where you can see these numbers essentially shown in the decrease in the cash moving forwards. But this helps in Pfizer's eyes to establish them as a leading oncology for the next generation of breakthrough treatments for people with cancer. Now this is all positive, something that we are keeping our eye to so that we can get some value as to how much this will help the shareholders. Now other parts of our analysis include looking at insider ownership, insider movement, 0.06% in terms of the total. Now we notice around 108,000 worth of buys over the last 12 months, no amount of selling during the same time period, and the more recent acquisition was in Q4 of 28,000. When we take a look to see who these insiders were, well, it was the director a few weeks ago. We can see by around 1,000 shares. Now, as always on this channel, we believe insider buying is a bullish signal because ultimately they believe the share price will go up. This amount is very trivial. Now the information is here if you want to use it in your own investment thesis, but again, for transparency, we will just show you this is the information going back 12 months. We then take a look for the same information but on institutions. 68%, around 7.8 billion worth of sales over the last year, a little bit more buying during the same time frame, and we can see in Q3 a lot more buying than selling, 2.01 billion versus 582 million of sales. Now remember, whether or not institutions or insiders are buying and selling, always do your own due diligence. Never copy what these insiders do and never follow them blindly. We then want to highlight the income statement. Now the revenue we've already discussed, the inconsistencies, the benefits COVID had for this company in terms of their top line, but ultimately what story does the bottom line net income tell us? And we can see, again, inconsistency being shown throughout, going from 9.1 billion in 2014 down to 2.1 in 2023. Now, positive to note is on a trailing 12 month, it looks like it is going to pretty much double for the full year of 2024. But just bear in mind, in your investment thesis, there is a lot of inconsistency on the net income. We then want to highlight the balance sheet, total health versus total debt. As always, looking at their cash first, which has decreased over the last 10 years, we can see the peak of the COVID where they had a significant amount of cash. Remember, part of that cash they used to acquire Seagen, and it's gone from 36 billion in 2014 to just under 10 in the latest quarter. Now remember, these numbers in isolation will not tell us anything, which is why we compare it numerically and directionally to their total debt, which, as we can see, very flat up until 2022, then a massive jump into 2023, nearly doubled from 37 billion in 2014 to 68 in the latest quarter. Now that is higher than their cash. We did see the net debt to EBITDA fluctuating around the levels of 2 to 2.5, but again, remember they are anticipating they will start to pay off a lot of debt moving forwards. Whether or not though that does give you any faith, that is something again to consider. We also want to have a highlight here of the cash flow. Something that we like to introduce is the cash from operations. Now, typically with companies that increase their top line revenue, we would expect the cash from operations to also increase. What we have noticed pretty much in line, and we can see here in 2021 the peak, but since then it has started to come down. So cash from operations, 17 billion in 2014, 8.7 billion in the latest annual accounts. Now, other parts of our analysis are looking at gradings. The first one, valuation, where they get an A, essentially showing us right now, if you are buying this company, the sector median is 20.34, so you are getting a 57% discount to the sector. Whether or not it is worth that discount, we can take a look, but the conclusion here for the valuation, no matter how you value companies, Pfizer is trading at a significant discount to the overall sector. Now, growth, D-, so you could argue, yes, it does deserve to trade at a discount. Revenue year on year, -14, sector +17. Moving forwards, -14, sector +8. And one thing we like to draw your attention to is the earnings per share over the next 3 to 5 years, +5%, whereas the sector looks a lot better at +11. So not great on the growth. Then we move on to profitability at an A+, 70% on the gross margin, better than the sector at 58. Bottom line, 7%, much better than the sector, which is burning cash, -4.5%. And we can see that from the cash from operations, 11.3 billion from a trailing 12-month perspective. As we mentioned, sector median not good at all, negative 15 million. So lots to consider. A quick conclusion for this part of the analysis: double buy from seeking alpha on Wall Street. You could argue quant are on the fence with their hold. A on valuation, D- on growth, with an A+ on profitability. Now, two more things before we look at our valuation process. Firstly, compare their performance against others in the same sector. We have Sanofi, Bristol Myers, AstraZeneca, lots of very well-known companies. Over the last year, now this includes reinvesting those dividends, you would be down 10%, the worst performing. Whether or not you could argue is a industry-wide issue or in isolation, others have performed fairly poor as well, something you may want to consider. Over the last 5 years, again down the worst performing, and now we can say it is in isolation. Others, whilst not the greatest, still looking positive at double digits. And over the last 10, if you were reinvesting your dividends, you would be up around 28%. I'm sure if you factor in inflation, you probably gained no money and you probably lost no money. Not great at all. But remember, past performance does not have anything to do with the future. They could perform much, much worse, in fact, but they could also perform much better. Finally, we'll compare it against the S&P, but I'm sure by now you already know the answer. Over the last 5 years, massive outperformance, and even over the last 10 years, when Pfizer has been positive, the S&P up 189%. And we usually do this just so you can have some consideration about adding a low-cost ETF into the portfolio. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $37 is just the average of these four models. We can run through them today. We have Pfizer, we have the EPS, the long-term growth rate, AAA corporate bond yield, market value, giving our intrinsic value here $41 under valuation. Remember though, we don't look at any one of these models in isolation. Then we have the multiples value, companies in a similar sector and size, their average P, the EPS, multiplied by that, giving us the intrinsic $37 valuation, and another signal here similar to what we just saw. We then move on to the dividend discount, where we have the yearly dividends, average growth 3.14. Moving forwards, we've got around 3%, a little bit more conservative, but again, another undervaluation signal. And then we move on to the DCF model, where we have the free cash flow year on year. We have the growth rate at 7%, in line with analyst targets. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, our fourth undervaluation signal. So intrinsically, this is just the average at $37.11 today. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pfizer or any others. Also, very key, we like to use a margin of safety at 10%, and we execute on companies at that level if they meet our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, we'll buy at $33, then we keep going till it's near the current trading price. And what we can see for this high-yielding company, right now you are getting a 30% MOS. Wall Street, as we saw, very bullish, buy signal, $33 in terms of the price over the next year. That is 29% upside. So give us your thoughts below for this high yielder. Is it a buy at the level around $25 to $26? 30% MOS is what we see. 29% upside is where Wall Street believe this will be over the next year. Buy, hold, or sell. And if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.